Good afternoon. My name is Joseph Litchower, and thank you very much for taking the time today to join us on this week's event, A New Era for Equity Income. Today, we'll be hearing from Thomas Moore, the lead portfolio manager of Aberdeen Equity Income, ticker AEI. And Thomas has been a manager on the trust since November 2011 and focuses on selecting individual stocks that he believes are best placed to deliver shareholders with an above average income, as well as providing real growth in terms of that income and capital. Before we pass over to Thomas, for those just not familiar with the format, Thomas will present on the trust for around half an hour or so, and that leaves us around 10 to 15 minutes at the end for Q&A. So if you guys have any questions that you'd like me to put to Thomas, please just pop them into the Q&A box on the bottom right hand of your screen, and we'll get to them after the presentation. So with that, it's my absolute pleasure, Thomas, to welcome you. Please take it away.
Thank you, Joe. Good to see you this morning, and thank you for everybody for dialing in. I'm going to kick off with some slides, and then we can move on to Q&A. So let's get cracking on the presentation. Here we go. Slide on to the first one, which is really about our vision. So income investing involves three aspects at Aberdeen Equity Income. We are looking to achieve an above average dividend yield, and we're also looking to achieve dividend growth over time. We've done that over a prolonged period of time. We've got 24 years of dividend per share growth. And we're also looking for NAV growth. And I'm going to talk today about how I see these three things coming together: yield, growth, and NAV growth. And in particular, what we're seeing coming through quite strongly this year is companies on high yields beginning to see their valuations re-rate. So we're not hugely dependent on the economy motoring, because it's not been, let's face it, so particularly here in the UK. But we are seeing companies that are trading at valuations which are just far too low. So that is the vision. We're looking to identify these stocks that can help us to achieve all three aspects of our investment objective. And that, I would call that the nirvana. When that comes through, we get that positive news flow coming through on earnings, that's feeding through to dividends. So we get the high dividend yield, we get the dividend growth, and then the stocks valuations re-rate. And let's face it, at the moment in the UK, valuations are extremely low, so low that even this morning, there's been another bid. In fact, two bids this morning as I speak for UK companies coming through. And we've had 4 bids in the past 12 months, which has helped drive performance. So we do believe that income and growth can be delivered hand in hand, and we don't see any compromise. So if we move on to the next slide, I'm going to give you 3 stock examples to begin with. And I think the reason why I'm going straight onto the stock examples is I think many of you on the call will know a lot about UK stocks. You've been looking at the UK market for many years, and I think it's a great way of bringing it to life. And then we can talk about how it all comes together in the broader portfolio. So case study 1, Imperial Brands. Now I have labeled this, if we had to pick one of those 3 elements, yield, growth, or valuation re-rating, I would select dividend yield as the hallmark of Imperial Brands. But that's not to say that they aren't delivering dividend growth and valuation re-rating. We are getting all 3. But let's cast our minds back to 2020, 2021. Why were shares in Imperial Brands trading at £15? And in fact, they'd been slightly lower. During COVID, they got as low as £12. Today, the shares are nearly £26. So how is it that a perfectly solid business like Imperial Brands got to the levels of sort of mid-teens, sort of, you know, that sort of £14, £15 a share? How come that happened? And I think the answer to that question is that stocks are mispriced regularly. It happens. And I think therein lies a huge encouragement for all of us who invest. As long as there are companies like Imperial Brands, which are producing brilliant cash flows year after year, they've got a fantastic market position, and they are seeing that the cash flow they're generating, they're using it to pay dividends, but they're also using it to do share buybacks, and together that's helping to justify this share price appreciation that we're seeing. Now, of course, going through your minds, maybe, well, look, this stock is in a sector which is X growth. Well, yes, tobacco volumes aren't growing in developed markets. They are still growing in many emerging markets, but pricing is going up. So we get positive growth in revenues at Imperial Brands, and then you get the magic of their management team, who are focusing on fewer products, the key brands, key geographies. It's the old 80-20 principle that if you spend the bulk of your time on the few things that you do really well, you become a much more effective company. And I think that applies to all of us as individuals as well. So this is a great business, and they are achieving great things. And you can see that the dividend per share, this is the annual dividend per share, has been rising from 139p in 2021 up to 153 this latest financial year. Just had results, well-received results. Shares went up a lot on the day of the results. So look, it makes sense from an investment perspective. It was yielding mid-teens if you include the buyback on top of the dividend. So at the lows, it was yielding about 7-8% dividend yield, but it was also yielding 7-8% buybacks on top. So they were using the same amount in dividends as they were in buybacks. So it was a wonderful capital return, about 2.5 billion a year. And if you think about what that means, is that how did we have conviction in this? Well, the reason we had conviction in it was that if they carried on buying back that many shares and paying that many dividends, we would get our money back within a matter of 7-8 years. Because obviously, if you compound at mid-teens, you get your money back pretty quickly. So that's not a bad risk reward. And the wider market was blind to this. So I do think it's important to say these mispricings do exist, and we are scouring the market for them all the time. The fact that they exist in mega caps like Imperial Brands is even more enjoyable, because that means that you don't always need to scour down in the bottom end of the market. We do that, but we can also find winners in the large caps as well. And it's interesting, this stock's performing a lot better than many of the sort of high profile sexy names like Diageo and Pernod, and you look at some of those sort of names that were darlings are no longer darlings. Nestle is another one, that actually Imperial Brands is producing much better shareholder returns at the moment. So we've got a capital markets day coming up in March next year, which I will be attending, and I'm looking for for further evidence there of delivery. Now, the second case study, Galliford Try. You will know the name because they are one of the UK's largest construction businesses. They are in a sweet spot, and you can see that from the share price performance that they've really got their act together. Again, a bit like Imperial Brands, focusing on what they're good at. They've decided to focus particularly on niches like water. Water is a key market for them, and there are only a handful of players who can do water infrastructure in the UK. They are one of them, and that's having a fantastic effect on their operating margin, because whenever they're bidding for the latest, it's called AMP8, it's the latest regulatory round of capex that these water companies need to do, because all of us want to be able to swim in the seas during the summer, in the English Channel or wherever you live. At the moment, it's a bit patchy where you can swim because the infrastructure is creaking. And so clearly there's a lot of investment to do. They are the cutting edge of that. That's helping them to deliver this wonderful dividend per share growth. You can see these are half-yearly dividends. We've had a special as well last year on top of these ordinaries going up nicely. And it's interesting that this business spun off from Vistry, which has got itself into a bit of trouble. We sold our Vistry a little while ago. And I think what's interesting here is, again, the company that people would have dismissed as, oh, it's just a construction company, a bit like Imperial Brands, just a tobacco company. We don't want to invest in those. Those are not growthy companies. But look at the share price that we've achieved here for our shareholders. And we're looking to do this. We're looking to replicate the success across the broader portfolio. So we think there are some further catalysts for performance there. But if I move on to the next slide, this is my third and final stock example. We can talk about other stocks later in the presentation as well, or in the Q&A. I wanted to talk about a business that is a dealing business. Their customers are mainly banks, and they are what's called an interdealer broker. So if a firm like Aberdeen or Schroders invests in fixed income, it's very likely that some of the fixed income securities that we invest in will be dealt on the TP ICAP platform. That's their key niche, is fixed income, government bonds, corporate bonds. They also do commodities, they do some equities, they do foreign exchange. So they've got a broad range of asset classes. Now, if you think of the LSE, they do equities. Now, TP ICAP does fixed income and all these other asset classes. So the range of asset classes that TP ICAP deal in, they're effectively exchanged on all these different securities. That's a much broader and bigger end market. What's really exciting isn't so much the volumes they achieve, which are great, but it's actually the data that they generate from dealing, being the biggest interdealer broker in the world. So I think that really a hidden jewel, the jewel in the crown, is the data business. And anyone who's followed LSE knows that actually data is what's made LSE into a fighting force globally. And I think the same thing is now about to happen with TP ICAP, which is extremely exciting. When you're an income investor and you suddenly find you're sitting there and one day somebody starts talking about a stock as if it's a growth business, which, let's face it, data is. Data is one of the big growth industries in the next 10 years. The use of data is going to define many companies. So TP ICAP can provide massive amount of data that's going to catalyze the stock, and I think that the share price can keep going. And we're getting this lovely dividend as well coming through. So that's a great business, and that's the re-rating coming through. So I've talked about three things: dividend yield, dividend growth, and valuation re-rating. So let's keep going, and these things will keep coming through. So we've got dividend per share growth. The dark line is the EPS, which is really the portfolio income that we generate, and the light blue line is the dividend per share. That's what we pay out. Now, you can see that there is an aberration in the rising trend since I became manager in 2011. The aberration was clearly COVID. There was a significant change during COVID. So actually the axes is slightly out there, but you can see the big dip is the year to September 2020, and September 21 we had the rebound. So you can see now that the latest numbers are that we've covered the dividend again, which is great, and we're on track. We've done 22.9p of dividends per share in 2024, so that's good news. And we have covered that dividend with the revenues that we generate in terms of portfolio income. So that's all very good. I mean, I'm just pleased to be back on track in terms of the dividend cover. We've covered the dividend 3 years in a row now, in 22, 23, and now 24, and that's how I intend to maintain it. So looking forward to a broader range of dividends in the year ahead as economies around the world hopefully start to recover after a pretty difficult period. So moving on to the next slide, I wanted to show the range of dividends that we're achieving across the UK market. The market cap down at the bottom, that gives you a flavour of how we invest in smaller cap stocks. So on the left-hand side of this slide, you can see that we are looking at companies all the way down to that yield that are yielders down below 500 million. We've got lots of small caps that are capable of generating lots of cash, paying lots of dividends. We've got lots of mid caps between 500 million and say 5 billion. That's probably the best definition of a mid cap. And then the large caps towards the right, which have got a market cap of up to about 100 billion. Those are the names, like, as you would expect, people like Shell, the large caps, which generate lots of cash again. So that's what they've all got in common. They generate cash. They're able to grow their businesses, invest in new growth initiatives, buy back shares, and importantly, pay dividends. And you can see that we are exposed roughly 50-50 between FTSE 100 names and everything else. And the everything else is mid caps, the 250, small caps, AIM stocks, and stocks which are listed in the UK, which are not in any index. And I'll give you an example of that would be BHP, for example, which is an Australian business now. It's delisted in terms of the index, but it's maintained its London listing. So it's no longer in an index, but it's listed in London. So that appears in other. And we've got just under 10% there. But these, I should stress, this isn't unlisted stocks. These are all stocks that are listed, but they may not be in an index. So we think that breadth of opportunities gives us a good opportunity to deliver those three aspects: the yield, the growth, and the valuation re-rating. And here, what we're doing with these two pie charts is showing where we're exposed. So we've got, again, just over half overseas. So although these are UK listed stocks, they're all listed in London. They generate their sales, their revenues, right across the world. So we've got 57% outside of the UK and 43% within the UK. And you can see outside of the UK, it's pretty broadly split there between the Americas, between Asia Pacific, and Europe, Africa, and the Middle East. And on the right-hand side, you can see how we're exposed in terms of the big sectors. So financials is a big weighting. We see lots of opportunities there. But I should say financials is split between lots of different subsectors. We've got banks in there, which are generating lots of profits at the moment, with interest rates staying higher for longer. We've got companies like private equity companies in there. We've got motor insurance. We've got life insurance. We've got, you go all the way down the list. You find lots of different subsectors and niches there within financials. On top of that, we've also got, you can see, energy and materials, which have been very good generators of cash over the last 3 years. And it's turning into quite a cold winter. So it's interesting to see performance of those stocks kicking on in the last 2 or 3 weeks, because people have suddenly realized the sort of shortages that we saw when Russia first invaded Ukraine may recur. From a humanitarian perspective, of course, we don't want that to happen, but of course it can only be good news for companies that produce the materials that heat our homes. And when the wind doesn't blow, of course, you still need all these other conventional power generation. So it's really quite an important theme, that I think, in an environment that we're in at the moment with geopolitical risk abounding. And then, of course, on top of that, we've got consumer stocks, and we've also got real estate stocks. So that's really how the portfolio is composed. And then if we move on, just going back to the top 10, I've already talked about Imperial Brands. I've talked about power just now, about the challenge really of energy security, the need to invest in infrastructure. That's going to be a key driver of earnings at both SSE and National Grid, which is very, very important. Obviously, there is also a need for all of the materials and commodities that power everything we use in our daily lives, and clearly that's quite helpful. The fact that there are still regular worries about security of supply means that companies like BP and BHP are in a good place to provide those energy to us. Then clearly on top of that, we've also got some stocks which are further down the market cap spectrum. So mid caps such as Conduit. Conduit is a reinsurance business. It was a startup about 4 years ago. It listed on the stock exchange. It's starting to come into its own now. It's a Bermuda-based business, and they are now generating lots of business. It's a hardening market, which means that rates of insurance are going up, and that's a good environment for them to be starting up. So Conduit's performing very nicely. It should produce a really good return on equity, which is the main metric that people judge insurance companies on, probably a mid-teens sort of return on equity this year, which is great. And then on top of that, we have got some consumer-facing businesses. I should say we are very selective at the moment because we need to talk about what's going on in the UK. The consumer is not feeling terribly confident. We've got Berkeley Group in there as a holding. And I think it's important to say that Berkeley Group really isn't just dependent on the UK consumer. Berkeley Group is mainly a London-based house builder. And so Berkeley Group actually generates quite a lot of its sales from outside London, people looking to buy a home in London from overseas, and that's their niche. So that is the key buys and sells. These are the biggest 3 buys and the biggest 3 sells over the last 6 months. And I've talked about Berkeley, their very, very good business model through the cycle, generating a really good return. They've not traded at this level, sort of about just over 1 times NAV. They have not traded at this level now really since the early 2000s. So we are looking at a very, very low valuation by historical standards at Berkeley Group. Petershill is the private equity division of Goldman Sachs, which is now coming into its own. Still a very cheap stock, but there is more enthusiasm now for private markets with interest rates having peaked out. M&G is a great cash flow generative business, really using the cash they generate from when they're the old legacy book, life insurance book is maturing. They're using that to fund growth initiatives. Internationally, they've got a lovely product called Pru Fund, which is really a old with profits fund, and that's selling like hotcakes at the moment. In terms of sales, really the biggest 3 sales are all M&A bids. I did mention at the beginning we have an M&A frenzy this year in the portfolio. We had 4 companies, so as well as DS Smith, Hargreaves and Sentiment, we've also had Timon, and we've reluctantly had to part company with those names. They were too cheap, and overseas investors simply said, look, we can't ignore those cheap valuations. And I think that's the point I'm making with this slide as well, that even now with companies being taken out, what the portfolio is just is really crammed full of cheap stocks. 9 times median price earnings, nearly 6% median dividend yield, dividend growth of 4.6%, free cash flow yield of 9.3%, return on equity of almost the same as the wider market at about 12%. But much cheaper valuations, 1.1 times price to book, and less indebted, so 1.2 times net debt to EBITDA. So we look at this because we want to make sure that the portfolio is positioned to perform. I mentioned the macro. I'm going to say a few words about the macro. I think the last month has been fraught with risk for investors, but I'm pleased to say that we are managing to anticipate what that could mean. And I think that on the left-hand side of this slide, I should just say, I am as nervous as everybody else about the UK because we have gone through 100% debt to GDP. It's a bit of a landmark. It's not a good landmark to go up through 100% debt to GDP. If you think about an individual, the equivalent would be they've maxed out on their credit card. That they're up at their limit, and the gilt markets are beginning to sit up and take notice, and that's why bond yields went up when Rachel Reeves presented her budget a few weeks ago. Bond yields went up, and actually that was bad news for consumer companies because that means higher mortgage rates, it means higher rates into companies as well. So less growth, and then on top of that, she's been raising taxes. National insurance on employment is the main one, so there'll be a dampening effect on the employment market. So I am quite cautious on UK domestic names as a result of that. We are quite selective about where we go. Now, in terms of US, I'd say it's a very different story, which is the US is going for growth. As you would expect from a property mogul like Donald Trump, they are going to be moving quite fast to generate economic growth. They're going to be looking at regulations. They're going to be looking at energy costs, how they can drive that. They're going to be looking at healthcare reform. They're going to be looking at tariffs. Now, tariffs aren't so good because that will raise inflation. But net, it looks like the Trump election could catalyze quite a bit of sector rotation. And we are positioned for that with our existing holdings. And we've been adding to some of those to make sure that we are going to benefit from the combination of slower growth here in the UK, but probably faster growth domestically in the US. And I think that's put us in quite a good position with lots of financials and some dollar earners, some defensive names like the tobacco names, which have been producing really good performance in this sort of environment. So again, moving on, the opportunity here in the UK is that both large cap and mid caps are cheap. This is a history going back to the year 2000, and you can see that it's not often that these lines have been as low as they are now. So we're on just below 12 times PE in terms of the market. As I said, we are much cheaper than that. We're more like 9 times. And then within the UK market, if you can see that on the right-hand side, we've got lots of exposure to these cheap sectors like financials, energy, basic materials, which is mining, utilities. We don't have telecoms, I should add, because I just think that the structural challenges there are just too much for those names. But we do have the other cheap names on this list. And so we are exposed to cheap sectors, cheap stocks within a cheap market. In terms of what that means for us, well, look, we are delivering on the income, and I'm really pleased about that. We're delivering on the income, which means that actually we are able to generate a decent return, even just from a standing start, just at the beginning of each year. You can look at that dividend per share and say, look, we're looking to achieve a growing dividend per share. Therefore, currently yielding 7. Actually, I'm very confident that we're going to be able to deliver that year upon year as our companies grow. So that's point number 1 is, look, that 7% yield is a great baseline for your total return from Aberdeen Equity Income. If as I do, you agree that there is huge opportunity for UK names, UK companies to achieve that valuation re-rating, as we've seen this year, names like TP ICAP, look, we will see further capital appreciation if that does happen, and of course the earnings growth. And then just finishing off, look, well-run companies, asset allocation is interesting at the moment because there's so many people have given up on the UK. We think that's an opportunity. Dividends drive returns, as I've said, that 7% starting point is a great starting point. Payout ratio is modest, about 2 times cover, 50% payout ratio. That's a pretty good starting point in terms of dividend growth. And then look, our index agnostic approach, we look across the market. We're looking for that positive change that can drive that valuation re-rating on top of the dividend yield and dividend growth that we're achieving. So look, we see it as a great story. It has been a while since COVID that we've not seen that valuation re-rating. The market has not been willing to accept that these companies are too cheap. And I'd say that's the key difference this year versus previous years. We're starting to see, at last, share prices respond to all the good news that we spotted. We put these names in the portfolio because we believe in them and we believe in the good news stories that they represent. That's starting to come through in share prices. So with that, I'm going to pass back to Joe.
Thank you, Thomas. Yeah, really appreciate you going through that. And I think it's a quite exciting time really to be looking into the UK. And I guess on that front, I think it makes sense to kick off with valuations. I know you've alluded to that already throughout the presentation, but when talking about the UK, discussions of late always seem to kind of come around to that valuation point, and in particular case of international peers. So I think it would be really good if you could paint for our listeners a bit of a picture on how cheap the UK stock market is really versus the international market, and perhaps draw on some of those stock-specific examples within AEI.
Yeah, I think that's important, as you say, and I think maybe what we'll do is go back to the slide on valuations, because I think this is key. Actually, when I look at the wider market, I think it's important to stress that 12 times you look at you look at 12 times earning, you think, well, what does that actually mean? Well, one way of thinking about it is if you flip it around and you say, instead of it being price over earnings, if it becomes earnings over price, so how much earnings does a company generate, and what's its price, or what's its market cap if you're doing the operating profit of a company, profit after tax divided by the market cap. That gives you a sort of sense. Now, if we sort of say, you know, a company on a 10 times PE is really on a 10% earnings yield. Well, I mean, there are lots of companies with those characteristics, and so I look at that and I just say, well, look, those companies, I hope that makes it feel more real. And then of that 10%, you see some of them are going to be paying out 50% plus. So you're getting 5, 6, 7% dividend yield from companies that are generating 10% of their market cap each year in earnings. So I think that's just sort of make it real. You know, what otherwise 12 times earnings just seems like a sort of bit of an abstract number. And then if we go to the most expensive market in the world, it's clearly the US. Now, obviously people quite rightly will say that's because of tech. And yes, lots of tech firms deserve a high rating because they're growing very, very fast. But even if you strip out the tech names, the US market is still the most expensive market in the world. And then in between the UK and the US, you've got all these European countries, you've got all these Asian countries. So really you've got I mean, the UK is down there at the bottom of the list, and we're alongside. I'm sorry to say it because it does grieve me, but we are down there alongside countries like Brazil. Some of these sort of the countries you would say, oh, well, that's a bit of a, you know, problematic area politically. You know, you would say, well, you can understand why countries like Brazil are on a very low rating. Well, the UK is down there in that same ballpark, and that's an opportunity, I think. But obviously, you know, it depends on, you know, where you're exposed, and there will be some companies that stay cheap. We need to avoid those.
Interesting. And I think on the valuation front, again, in your non-benchmark allocation, which you touched on earlier, Thomas, does that include overseas stocks? And if so, has that valuation dispersion that we're seeing relative to those international markets influenced your thoughts on allocating more to the opportunities you're seeing on home soil?
Right. I mean, there are no overseas listed stocks. So it might be that some of our names have a dual listing. So they might have mentioned BHP, they've got a listing in Sydney and they've got a listing here in the UK, in London. So that's the nearest I get to owning an actual overseas stock. And of course, a lot of my names, as I mentioned earlier, have got overseas income. So I'll just get that slide up again, the one with the pie charts. I think this gives you a flavour of how international the portfolio actually is, because if you're TPI cap, your main geography is actually not the UK, it's the US. You know, that actually there's a huge, obviously there's a lot more fixed income traded in the US than there is even here in the UK. So companies like TPI cap are, you know, truly international. And I'm not really tempted to go further than the UK. We've got over 500 names that are in the index, plus, as I said, non-index names. So I really don't feel the need to stray into overseas listings. I mean, let's face it. I mean, there's enough value in the UK that's enough to keep me going. And certainly, in terms of generating income, I don't think there are many markets around the world with the income characteristics that the UK has.
Yeah, absolutely. And I think it's quite an interesting point to think of those underlying UK businesses aren't just tied to the UK. You know, like you said, they've got those underlying revenues from overseas as well. So that, I guess, kind of brings in the overseas element to the portfolio, which is interesting.
Yeah.
Not on the performance front, Thomas. It's a bit of a two-parter, I think, but we'll kick off with the first part. NAV performance this year is strong, and it would be really good to kind of get an idea from you with the sense of tailwinds. I know you mentioned a lot of bids and a lot of M&A action has contributed, but some tailwinds would be good nonetheless. And on the flip side, it would be good to get your thoughts on the share price performance. And compared to some peers in the sector, that lesser share price performance is a bit of a talking point, I guess, for some investors. And it would be good to get your thoughts on whether you think, it's AEI's higher dividend yield, or if it's the weight of the wider market sentiment that's causing that.
Yes, I mean, I think obviously we always need to look forward whenever we're talking about performance. But I'm very, very happy, and I should explain performance going back as well, because people will naturally look at that and talk about, what does that mean? So in the past year, we are up near the top of the AIC UK equity income sector. So we are sort of right up there, and I'm very pleased that strong performance has happened in the past 12 months. I think that's for the reasons I've given, that finally the index agnostic process, actually looking at companies right across the market, finally is coming into its own. Now, it has been a long time. Was I obstinate in sticking with, an all-cap, multi-cap approach when, frankly, post-COVID, and even actually before COVID, people decided, with all these outflows from the UK market, they decided, look, let's just give up on small caps and mid caps. That's why valuations are so low now. But I was stubborn. I stuck with many small caps and mid caps during that period, and it didn't help. So I think that's the main thing to say is, look, if you go back and look at the share price over 3 years, 4 years, 5 years, you will see there hasn't been much growth. It's been back and forth. I believe that's played out now. That sort of boomerang in terms of small caps being out of favor, back in favor. Look, I think we've reached, I would like to think anyway, that we've reached the nadir of that. And why would I say that? Well, let's say, look, M&A, first of all, is a huge underpin. And the fact that 4 names, we've only got 50 names in the portfolio, 4 of them were bid for. And that's a pretty good hit rate in terms of M&A. So look, if we hold stocks that are out of favor, many of them small caps and mid caps, in the end, M&A comes along and sorts out that valuation anomaly. Buybacks as well. Look, it's basically a slow burn M&A situation, really, because it's the companies themselves buying themselves. So look, I think that's the main. The evidence is now we've got that underpin from M&A and buybacks. And then on top of that, look, I think there's just more of a sense of a two-way market. I think if you look back to 2018 onwards, it felt very one way, and it was very much that there were only sellers of mid caps and small caps, and that definitely held back performance of AEI. I do think that if you agree with me that those days are now largely behind us rather than in front of us. I mean, you can only sell a share once, after all. And let's face it, most of my peers and most people internationally seem to have actually just given up on UK domestic. So I think that's a pretty interesting scenario for me. The shareholder lists are now basically done their stuff. This selling pressure has largely dissipated.
I guess on the kind of domestic side, are you worried is perhaps the wrong word, but are you conscious that the recent Labour budget seems to be, at least from the consensus of a few economists and analysts out there, a bit anti-growth? And I guess your thoughts on how this will impact your views on the market, but also AEI's positioning.
Look, Joe, I'm not going to pretend that the budget was helpful, because it really wasn't, and I think it's important to be straight about that. I would love to have come on today and say to you, look, there's every reason to be bullish on UK domestics. I am not going to say that, because we've got a chancellor who's decided to whack up taxes quite aggressively, and that's had an impact not just in terms of lower earnings for big UK employers and small and medium-sized businesses that employ lots of people, which they will, I'm afraid, pass on in due course in terms of higher prices. So inflation stays sticky, and they may pay people a bit less as well. They may just have more machines, more self-checkouts, etc., you name it. It's not very good for growth. And then secondly, the borrowing costs going up is, it's not quite on the same scale as Liz Truss. That was short and sharp. This has been more of a creeping increase in borrowing costs. So look, I mean, all I can say is I'm not gonna create a sort of fabricate a bull case on the UK domestic economy. But there's an awful lot priced in, and there's an awful lot of bad things going on in the rest of Europe. In France and Germany, they have their own crises. So that doesn't make what's happening here in the UK good news, but it does put things in context that every country is going through a version of what the UK is going through at the moment. And so I am extremely careful now. I'm not going to get lured into any old UK domestic stock. If we do buy a domestic, I've got to be really high bar of conviction in order to back that stock and put shareholders' hard-earned capital behind that.
No, absolutely, and that makes a lot of sense. And I think leads quite nicely actually into the next point on the investment trust yield, which is around 7%, depending on the day you look at it. But it'd be really useful, I think, Thomas, if you can talk us through how you comb through a universe like the UK and pick out those companies, with quite low valuations, but that you think have, good upside potential, proven track record with management, etc., and put aside those that are potential value traps, because I guess that's the challenge, right? Identifying the differences between the two.
Yeah, that's right. I mean, I think if I give you my really, I think the most important thing right now is give you my let's start with the vision and the sort of how we do things. So I think that's important. So first thing to say is you hear this thing about value trap, it's got a cheap valuation, it's got a high yield, and therefore it must be a value trap. And I think the important thing to say is I really reject that. And I think it's important as an active investor, and as an active investor who sees lots of irrational stuff happening in the market, there's this waves of selling by overseas investors, by wealth managers, that people have given up on the UK. And that creates share prices that have gone down a lot. Now, how on earth is it rational to say that those share prices represent the truth? Because the truth is that these companies are still the same companies. They're still good companies. There's just been more sellers than buyers. And that's what's created a scenario in which share prices have fallen and yields have gone up. So I completely reject the notion that somehow every high yield company must be a value trap. So that's the kind of point, that's the vision, that's the kind of high level starting point for being positive, being open-minded about stocks with higher yields. It's not that I'm lured into value traps. It's more that I think other people are creating value opportunities by just selling willy-nilly. And that's really the story of the last 4 or 5 years, even before COVID. And that's the opportunity. So I think that, and I've given you 3 examples at the beginning: Imps, Imperial Brands, Galliford Try, and TPI Cap. I could carry on all day talking about these value opportunities in the UK market, but you get the picture. In terms of the vision I've got is stay positive, stay proactive, be opportunistic, because if you agree with me there are these opportunities, then somebody has got to go for them, and I'll leave others to do the chasing, high growth names. That's not my bag. I'm not going to do that. That's not going to be what Aberdeen Equity Income ends up doing. We need to look for the mispriced stocks that are on completely the wrong valuation with a yield that's become too high, not because it's unsustainable, but because the share price has gone down too much.
Fantastic. No, I think, Thomas, that's really nice way to picture the vision that you guys have got and what you focus on in the market. So thank you for that. And I think really to end the kind of Q&A session, I think it would be really good to look forward a little bit, as difficult as it might be. But in terms of entering 2025, what is your outlook on the stock market, where do you see those opportunities, and where are those areas that you potentially think are worrisome?
Yeah, well, that's what we're paid to do. We're paid to worry, and so that's the I certainly have lots of reasons really to be paranoid at all times, because that's what I should be. I should be constantly checking where could I be wrong. And so if we start off with what the macro environment, I think, is quite changing at the moment. And actually, look, I think if we're going to describe the macro, and even looking back 3 years, 5 years, it's been a kind of boomerang. It's been rates are down, rates are back up. Then people thought rates were going to fall. Well, now they're falling a little bit, but not very much. And that's having an effect on sectors and stocks. So I think first thing I would say is, look, I'm paid to worry, but I'm also, I think, paid to make sure that the portfolio is positioned appropriately in a very rapidly changing market. And I think that might mean that over the next 12 months, we pull our time horizons in a bit and we say, look, who's to know what's going to happen with Ukraine and Russia? Who's to know what's going to happen with the Middle East? What's Trump going to do? In the past, it's been quite unpredictable what Trump has done. So I think actually having a portfolio that fits this current environment quite nicely, which we are seeing playing out this year. So year to date, i.e. since the 1st of October, we're up nicely relative to the index. And the reason for that is that we've positioned for this environment for higher for longer interest rates. So lots of banks, the big banks are doing extremely well. People like TPI Cap are doing extremely well. Quilters, the fund platform, is doing extremely well. All of these companies are generating lots of interest income. So that would be one example of an area where we can say, look, higher bond issuance, Donald Trump equals higher for longer interest rates. Position accordingly. And so we do that across each of the sectors, make sure that we're in a good place. And I think that's starting to come through. And it's been as I said, it's been a trying environment for some years with small and mid caps out of favor. I think that was then, and this is now. And I think from here, AEI, Aberdeen Equity Income, has a fantastic opportunity to sort of make sure we are on the front foot. We're positioned for a very, very rapidly changing environment. We're doing that day by day, week by week, and it's actually a great feeling being in the right place for this sort of changing environment.
Fantastic. Thank you very much for that, Thomas. That's, I think, been a really, really insightful update on the trust, but also the broader UK market. So very much appreciated. But I think that is all we've got time for. I think we've come to the end of the webinar today. So a big thank you to those listeners who dialed in. And for those that are wanting any further information on AEI, the team at Aberdeen published some really quality information on both the trust, but also broader insights and outlooks on the market. So with that, Thomas, a massive thank you for joining us today. It's been great to have you on.
Thanks, Joe. Appreciate it. And as you said, please come back for more if there's any inquiries. More than happy to help.
Brilliant. Well, with that, guys, thank you very much for joining us today, and we look forward to seeing some of you tomorrow for the last webinar of the week. Take care now. Bye-bye.